All right, Market Heroes, we're back. So I completely get it, and I completely hear you guys. Iron Condors are a great strategy. They're a great strategy for a lot of reasons. Number one, anyone can do them, right? So it doesn't require a margin account. Number two, your risk is defined on order entry, right? So you don't have undefined risk. And number three, the return on capital is pretty high for these, again, because they're defined risk trade, right? If we In the first lesson, we talked about a $5 wide iron condor where we're selling a $5 wide put spread and a $5 wide call spread where we're collecting $2.50 or half the width of the strikes, right? That if we make full profitability on that strategy, that's an 100% return on capital, right? We're only putting up $250 to execute the strategy because, again, we are required to put up our max loss on that trade. And if our max profit is $2.50, we could make 100% in our money, right? So iron condors are a very high return on capital. They don't make as much money over time as, say, a strangle or a straddle or an undefined risk trade. They also don't give us the same probabilities of making money as a undefined risk trade. However, they do define a risk and they do give us a high return on capital. So that's a little bit of a trade-off that we have. So a lot of people are saying, all right, dude, look, Steven, I really like iron condors. If I just want to do iron condors because I get it, it's undefined risk, it's high return on capital, like I can wrap my head around it a little bit more, how much of my account should I put into iron condors, right? Let's find out. So again, real quick, back to the basics. What's an iron condor? Selling a call spread, selling a put spread at the exact same time, right? To sell a call spread, we sell a call and we buy a call further out of the money, right? This is a call spread, right? Selling a put spread is selling a put, buying a put further out of the money, right? Doing those together, whoops, didn't do them together. Click. Is an iron condor, right? So here we are, our max profit is 159, our max loss is 141, right? So again, very high. There's over 100% return on capital potential on this strategy, right? So again, that's what draws people to iron condors. We make money on this strategy if, number one, prices fall between our two short strikes. Our two short strikes here are 249 and 243, right? So if prices fall between those, we make money. At the same time, if the expected move or implied volatility decreases over the time of this strategy, we'll make money too, because as implied volatility decreases, so does the price of these options. And since we're selling them, we profit from prices going down, right? And again, an iron condor is nothing more than selling a strangle and selling a straddle and also buying the wings too, right? So again, you guys want to know how much of the portfolio should be devoted to iron condors if we want to do a great job, right? Okay, so here we go. Well, for this strategy, we did 12 and a half plus years of data, depending on when you're watching this video, right? And we wanted to see exactly how much of the portfolio should be allocated to iron condors, right? So what we did was we compared the returns of the market, and the market is going to be represented here by SPY, which is the S&P 500 Index ETF, right? And then we wanted to do with iron condors where we sold the 40 delta call and put and bought the 40 delta call and put, right? So let's see that trade. So if we're selling the 40 delta call and put, that's like doing the 40 delta strangle, and then we're buying the 20 delta call and put. So we're buying the 20 delta call, we're buying the 20 delta put, right? So that's all it is, right? So this trade itself would be, we could make 251, we can lose 449. Our break evens are 241.49, 250.51, right? So we make money if on this strategy if prices fall between 241.91 and 250.51, or if the implied volatility of SPY were to decrease over this trade, right? So we did that strategy and we wanted to see if we should be allocating 15%, 20%, 30%, or 25% of the portfolio to these strategies, right? So what would happen is, let's say we had a $10,000 account, right? So right now we have a $10,000 account. That's how we're starting this out. And we're going to go ahead and we're going to do this strategy, right? So this strategy right here is going to cost us about $449 in margining, right? And that means that we're going to have to put up $449 just to execute this strategy because the brokerage will require us to put our max loss up, right? So what we want to do is we have a $10,000 account and we want to say, okay, how many times can I actually execute this strategy? And the way to find that is take the amount in the account and divide it by, actually no, scratch that. So we're going to allocate 15% of the portfolio in this example to these iron condors, right? So 15% of the entire portfolio, right, of the entire portfolio, and then we want to see how many times we can do this so that we can only allocate at the most 15% in the portfolio for doing so. So what we're going to do is we're going to divide it by the most we can lose, and it looks like we can do this 3 times, right? So if we had a $10,000 account and we could only at any point allocate 15% of our total account balance to these iron condors, we could do that 3 times here. Right? Now, if it was 20%, we could do it 4 times. If it was 25%, we could do it 5 times. And if it was 30%, we could do it 6 times. Right? You guys understand that? Cool. Right? Again, the most amount of money we can lose on a trade is the amount that we're going to have to put up to execute this type of strategy. So again, that's how it would happen. So again, we're going to start with a $10,000 account. We're going to sell the 40 delta strangle. We're going to buy the 20 delta call and put, which means we're buying the 40-20. We're going to sell the 40-20 iron condor, right? And we're going to allocate 15%, 20%, 35%, and 30% of the portfolio. And we're going to compare doing that and holding until expiration with each trade as compared to SPY. That's all we're going to do. Here are the results. So if we started with a $10,000 account at the beginning of 2005 and we bought and hold SPY including dividends, we would have right now about $21,705. So we double our money. That's pretty good. And during the financial crisis, the lowest the account value got was about $7,500, right? That's, look, it's not the end of the world if you end up with, making a double on your money. However, if we allocated 15% of the portfolio to the iron condor strategy that we're talking about, which again is the 40-20 delta iron condor, you would end up with about $17,000. However, the worst your account ever got during the financial crisis was still not even a negative, right? It's still not even negative, and it was much more. It was a much higher account value than if you just bought and hold the market. Similar results for 20%, but once we get to 25% portfolio allocation, we end up with a $25,000 account after those 12 and a half years, right? And still our lowest account balance was 50% more. No, excuse me, was about, it was about 50% more than the lowest account balance at any point during a buy and hold strategy, right? And you end up beating the market here by about 20%. Then if you went all the way to about 30%, which is really, really cool, if you went to 30%, you beat the market by about 15%, and your worst account drawdown was still about 50% better than the worst account drawdown. So if you're interested in allocating 30% if you're interested in having a portfolio that's just based off of allocation to an iron condor, right? The iron condor that we recommend is the 40-20 delta iron condor, and we recommend putting 30% of your net liquidation value into it at any given time. For the 12 and a half year period from 2005 to present, depending on when you're watching this, that would have beat the market by 50%. So I'll see you on the next video.